So let's proceed. So today I want us to cover some question on risk analysis in capital budgeting. Risk analysis in capital budgeting in portfolio theory. So open with me November 2019. November 2019, question 3. November 2019, question 3. Question 3 part, let's start with part A. Part A of the question we are told that using a well-labeled diagram, distinguish between systematic risk and unsystematic risk. You differentiate between systematic risk and unsystematic risk. Now we said what's a systematic risk. So that systematic risk and systematic risk, they are part of, or they are categories of business or total operating risk. And they say that they are risk which arises as a result of declining earnings of the company. Now systematic risk, they are risk affecting all the company or the industry in the economy. Therefore, they cannot be minimized by holding a portfolio. And they give an example of systematic risk. They are things to do with inflation, energy crisis, pandemics such as COVID-19. Then unsystematic risk, they are those risks that affect a certain industry in the economy, or a given company in the industry. So therefore, they can be minimized by holding a portfolio. Now, if you are to present them using a diagram, like that. Now, you see where they are same. Now, this is now what we call systematic risk. But the one that keeps on changing, those are what we call unsystematic risk. Unsystematic risk, that means they are diversifiable risk. Systematic, they are undiversifiable risk. So that's how you explain the difference between a systematic and unsystematic risk. So now let's do part B of the question. An investor has presented the following information relating to forecasted return of security Y and Z together with their respective probabilities. So we have the probabilities, then we have the forecasted returns required. The standard deviation of security Y and Z return, standard deviation. So how do we get the standard deviation? So before we get the standard deviation, number one, you have to get the expected returns. You get expected return of Y, expected return of Z. We have two security, Y and Z. So we start with Y. Y, we have a return of 10, probability is 0.1. We have 12, probability is 0.2. We have 8, probability is 0.35. We have 15, 0.05. We have 14, 0.15, and then we have 9, 0.15. Then you do the same for Z. 8 times 0.1, 10 times 0.2, 7 times 0.35, 12 times 0.05, 11 times 0.15, and then we have 8, 0.15. So, and you get the expected return here is 10.4%. And then for Z, we have it's 8.7%. So that's how you get the expected return. Once you get the expected return, now the question was to determine the standard deviation. How do you determine the standard deviation? Standard deviation, you take the returns minus the expected return, square, probability, you sum, and then you get the square root. So you compute standard deviation of Y, standard deviation of Z. So let's start with Y. You take the returns of Y. Returns of Y, we had 10, 12, 8, 15, 14, 9, You deduct the expected return. Now, expected return of Y we had was 10.4. Then what you get, you square, and then you multiply by the probability. Probability have 0.1, 0.2, 0.35, 0.05, 0.15, 0.15. So I just need the totals here. So the total is 5.84. Now once you get the total, then you get the square root. So therefore the standard deviation for Y in amount of 2.42. Now let's determine the standard deviation of Y, of Z. You take the returns of Z, of which returns we had 8, 10, 7, 12, 11, 8. You raise expected return of Z. Expected return of Z we have it's 8.7. Then you square. Then you multiply by the probability. 0.1, 0.2, 0.35, 0.05, 0.15, 0.15. Then you do the same for each, and then you add the total. So the total will be an amount of 2.81. Then you get the standard deviation. The standard deviation will be 1.68. 1.68. Good. So that's how you determine the standard deviation of each security. Number 2 is the relative risk of security Y and Z. Relative risk. Now when you talk about relative risk, we say that that is coefficient of variation. Relative risk. We compute the coefficient of variation. So that coefficient of variation shows the relative risk. And the trade-off between the risk, you divide by expected return, you multiply by 100%. So you compute CV for Y, CV for Z. You take the standard deviation for Y. Standard deviation we have is 2.42. You divide by the expected return of Y. And the expected return of Y, we had 10.4. Then you multiply by 100%. For Z, you take the standard deviation. Standard deviation is 1.68. Divide by the expected return. Expected return of Z, we have it's 8.7. And then you multiply by 100%. So here you have it's 23.27%. And here we have it's 19.31%. Then we say that standard deviation and CV, they are measure of risk. The lower the value, the lower the risk, and the better the security. So if you compare the two, that means for Y, we are taking a risk of 23.27% to generate 1 unit of return. For Z, we are taking a risk of 19.31. So which one has a lower risk? So the better one is Z. So the third question was, the last question was, advise the investor on which of the two security to invest in. So invest in security Z, since it has a lower risk. Good.